The biggest names in finance are at the Securities Industry and Financial Markets Association meeting in the Big Apple. On the list today, Tim Geithner, Jamie Dimon, Mary Shapiro, who we heard from in the last hour. Bob Pisani is there with another exclusive, Blythe Masters, one of the forces behind credit derivatives. Robert.
Thanks very much. She's rarely on here, but not only is she over at JPMorgan running the commodities business, she's one of the experts on commodities. She's also the outgoing chairwoman of SIFMA. Blythe Masters joins us now. What a year you have had running SIFMA here. Just broad brush, what do you think SIFMA has done to restore investor confidence? Do you think investor confidence in the securities business in general is being restored?
It's a great question. I think the most important thing to acknowledge is that the industry understands the outrage and the anger that people feel as a result of the events of the last couple of years, and part of acknowledging that has helped us embrace the need for change. And SIFMA is working hard to try to be constructive in that sense, working with the various policymakers, the regulators, to ensure that the right policy decisions get made from here, and there are a lot of them that need to be made.
You have been with JPMorgan your entire career, 20 years at JPMorgan, and you've risen up the ranks. You were one of the forces behind the creation of derivatives, CDSs included. Looking back on what happened, give us a little bit of retrospective. What do you feel went right, and what do you think went wrong with credit derivatives, with credit default swaps and other derivatives? What can we do to fix it?
Well, importantly, derivatives as a tool are vital for many companies around the world. They affect risk management, the ability to create jobs and grow, and we can't lose sight of that in acknowledging that there are also issues. There are two big issues, however, that I think, with hindsight, should have been addressed sooner and are now going to be addressed relating to derivatives. Those include generally a lack of transparency, particularly to regulators. And secondly, a high degree of interconnectedness, which leads to systemic risk, meaning that if one part of the system, one company were to fail, the implications for others would be so difficult to assess and so significant that it would be problematic.
And yet, why wasn't the issue of systemic risk sort of addressed by the people who were creating that? Did that come up in the 90s when these were being invented? Anyone say, good heavens, if we got all these out here, it can create systemic risk. It gets past our ability to handle it.
Ironically, many, if not all, of the early pioneers of the credit derivative markets were themselves operating within the fabrics of regulated financial institutions, primarily banks. So I think part of the omission in the thinking was caused by the fact that the assumption was that all parties would be subject to the pre-existing regulatory framework that already governs banks. The sad thing is that wasn't the case. So, for example, the likes of AIG emerged, became major players, but were largely, if not completely, unregulated, and therein lied the problem. That, in turn, is the reason why this industry and this economy needs a systemic risk regulator to capture that.
Very quickly, do you support derivatives being cleared and traded on exchanges? Are you in favor of that?
Central clearing and more of that is a positive thing. Mandating exchange trading in addition to that is an unnecessary addition. You get all the benefits in terms of reducing systemic risk through central clearing.
Very quickly, commodity prices. Do you think commodities are being somehow manipulated by speculators? This is one of the experts on commodities, and I'm sorry I'm going over time, Mark, but I've got to ask you. It's on the public's mind. Is it being derivative?
No, in the long run, it's not possible for investors to manipulate commodity prices unless they interfere with the underlying forces of supply and demand. And we have no evidence to suggest that causality. In the short term, of course, investor flows can affect futures prices, but in the long run, you've got to look at the underlying fundamentals.
Blythe Masters, always a pleasure to see you. Thanks very much. Mark and Aaron, back to you.